Alright, let's dive into what's happening in the markets today, because there's a lot to unpack, especially when it comes to the US dollar and its recent moves. Here's the thing, the USD is holding its ground, and personally, I think this is a direct result of the ongoing uncertainty in the Middle East. You see, markets hate uncertainty, and when there's geopolitical tension, investors tend to flock to safe haven assets. The USD, being the world's reserve currency, is often at the top of that list. But what makes this really interesting is how quickly sentiment can shift. Just a day ago, there was optimism about a diplomatic resolution to the conflict, which briefly weighed on the dollar. But as those hopes faded, the USD rebounded. It's like the market is hedging its bets, and in my opinion, this is a classic example of how geopolitical events can drive currency movements in the short term. Now, let's talk about the data coming out of the US today: goods trade balance, JOLTS job openings, and factory orders. These numbers are going to be crucial because they'll give us a snapshot of the US economy's health. But here's where it gets tricky. The market is already pricing in a lot of uncertainty, so even if the data comes in strong, I'm not convinced it'll be enough to push the USD significantly higher. What many people don't realize is that in times like these, data often takes a backseat to broader sentiment. If you take a step back and think about it, the USD's strength right now isn't just about economic fundamentals, it's about its role as a safe haven in a turbulent world. One thing that immediately stands out is the USD's performance against other major currencies this week. For instance, it's up 0.6% against the New Zealand dollar, which is notable because the Kiwi is often seen as a risk-on currency. This tells me that risk sentiment is still fragile. In a risk-off environment, currencies like the NZD tend to suffer, while safe havens like the USD thrive. But here's the kicker: the USD isn't just gaining against risk-on currencies, it's also holding its own against the euro and the yen. This raises a deeper question: is the USD's strength purely defensive, or is there something more going on here? Personally, I think it's a bit of both. Now, let's talk about oil, because it's impossible to discuss the USD without mentioning it. Crude prices rebounded after President Trump called off planned attacks on Iran, but the relief was short-lived. Analysts at Commerzbank pointed out that the underlying risk premium hasn't disappeared, and I couldn't agree more. The Strait of Hormuz is still a flashpoint, and as long as there's uncertainty around shipping through that waterway, oil prices, and by extension, the USD, are going to remain volatile. A detail I find fascinating is how quickly oil prices can swing based on geopolitical headlines. It's a reminder that in today's interconnected markets, nothing happens in a vacuum. Another angle I want to touch on is the recent FX intervention by the US and Japan. Analysts at MUFG highlighted that this move might be linked to concerns about dollar liquidity and potential treasury selling. What this really suggests is that central banks are not just worried about currency levels, they're also thinking about the broader implications for global financial stability. If you ask me, this is a big deal. It shows that even in a world of algorithmic trading and high-frequency flows, old-school concerns like liquidity and sovereign debt still matter. Finally, let's talk about gold, because it's always a barometer of market sentiment. Gold is stuck in a consolidation phase above $4,050, and ING strategists nailed it when they said it's caught between improving geopolitical sentiment and uncertainty over US interest rates. Here's my take: gold is the ultimate hedge, but it's also a prisoner of its own narrative. If rates stay higher for longer, as many expect, gold's upside could be capped. But if geopolitical tensions escalate, all bets are off. What makes gold so interesting right now is that it's at the intersection of two massive trends: monetary policy and global risk. So, where does this leave us? In my opinion, the USD's strength is a reflection of the times we're living in: uncertain, volatile, and deeply interconnected. But here's the thing, while the USD might be the safe haven of choice today, it's not invincible. If the geopolitical landscape stabilizes or if US data starts to disappoint, the dollar's rally could lose steam. What this really suggests is that we're in a market where sentiment can shift on a dime, and that's something every investor needs to keep in mind. As always, I'd love to hear your thoughts. What do you think is driving the USD's strength? Let me know in the comments below, and don't forget to hit that like button if you found this analysis helpful. Thanks for watching.